And I am super excited to welcome Tom West to the stage, a expert in long-term care insurance and financial matters, and someone who I've known for quite some time. And I hope I always like to recount my relationship with folks in this business that I've known for many years. And back in the good old days, in the early 90s, there was a lot of companies providing long-term care insurance. And one thing for sure, there was a lot of people out on the streets selling long-term care insurance. And I had met Tom, but how I really developed a great admiration for him as a resource was we used to, these meetings that we're having now, they used to be live. And back in the early 90s, we didn't have email or anything like that. So I would host these live events and I'd mail postcards to people and I'd send faxes and people would show up at these events. Well, so in January, we had this snowstorm. My speaker called me up on probably on my landline phone and said, I can't make it this morning, too much snow. And so I went to the Inova campus where I'd organized this event. And there was about 15 of us that all trudged through the snowstorm with no speaker, had no way to notify them. And I said, well, let's do this. Let's all just stand up on the stage and talk about who you are and what you do. And I was super impressed with Tom then, and I've been impressed with him over the years. He didn't slide into any kind of sales pitch. In fact, I thought I was staring at a college professor and not somebody that could actually sell a long-term care policy. And he's really used that formula over the years, and it's been very successful. So, hats off to a great career, Tom. And for those folks in the audience that don't know you as well as I do, tell us a little bit about your background, and then we'll jump into Man, we got a lot of questions in the queue already. So, all
Great.
right,
Well, listen, thanks for inviting me. It's great to be able to see you again and everybody in the audience. When you're talking about the programs we used to do back in the 90s, I'm imagining a full head of hair and a whole lot of years in my career ahead of me. For those in the audience, I started my career in long-term care insurance completely by accident. It ended up that I was really good at long-term care insurance sales. But I don't know that I would call it my career passion. I think that one of the things that it did early in my career was introduce me to lots and lots of families that were looking for ways to develop more certainty in how to pay for the possibility of needing long-term care help. And I was meeting a lot of people that had a lot of health problems that precluded them from being underwritten. And what that really did with my career was develop a path where not just long-term care insurance, but sort of more holistic planning of all of the different ways that you'd be able to finance long-term care and healthcare expenses and senior housing, et cetera. That's what I've been doing for the last 25 years. And I appreciate you taking me back down memory lane, Steve. It's a long time to think back for.
great. Okay, so now in the modern times here, one of the coolest things about being able to set up these discussions is if any of you in the audience hit me with a question or have an idea, you've probably seen where in a few weeks later we have a discussion on that topic. And the catalyst for this topic was a frantic phone call that I received from somebody who had a copy of Sourcebook, uh, who was really stressed out because she had just received a letter from her long-term care insurance plan that said her premium was going to increase 40%. And I immediately said, I don't know the answer to that, but I'd heard similar comments before, not talking about 40%. It's just I got this letter, and I'd always say, well, call the company that you purchased that from, or, I'd say, if they didn't have a relationship, I said, call Tom West. But so that's the catalyst of why we are gathering together here today. But I realize that many folks in the audience might not have a policy at this point and might be on this call just to understand what is long-term care insurance. And so I want to address that 40% question, but Tom, first, let's start with just what is long-term care insurance, and then we can kind of go back in time and talk about what long-term care insurance was 25 years ago, what it is now, and what you think it's going to be in the future.
Well, I mean, that's a great place to start. I think that when I'm talking about long-term care insurance and sort of what is it, right? Let's start with just a very high level ideas of how these policies are set up. And then what I'll do is I'll pull the screen down for a second and I'll track like where have we been the last handful of years. And then we can get into the questions about what do I do with long-term care insurance that I might have right now, premium increases and so on. Let's just talk a little bit about what is it that we're talking about with long-term care insurance. And basically, I would always start with anybody that asks, how do I understand my long-term care insurance policy? I'll lead with this because it's better to lead with it than to close with it. Sometimes I'll ask folks that are wondering about what they have in their policy. And the first question that I ask is, have you taken your policy out and read it? And the answer a lot of times is no. So a good place to start, and even though it's a little cheeky, if you have long-term care insurance and you want to know what you have, take out your policy and read it. 90% of it is in English, and the 10% that you don't know is really good prompts for questions. But Steve, how long-term care insurance is effectively built, what the policies generally are, is they're designed to pay out a certain amount of money, usually on a daily benefit, sometimes on a monthly benefit, to pay for long-term care expenses after they've occurred. And generally speaking, most long-term care insurance is set up on something called an amount of coverage that's described as a number of years or a pool of money. And I'll give you an example to make it easy. If you have a policy that covers $100 a day and you have a benefit period of 3 years, then what they do is they take $100 a day times 365 days a year times 3 years. And that's the amount of money that you have in a pool, like a bank account, that you can draw from up to $100 a day to reimburse for expenses as they're incurred. That's generally how long-term care insurance is set up. A lot of the long-term care insurance, certainly in the early part of my career, back when we were talking, Steve, had some element of inflation protection. How much could that daily benefit or that pool of money grow over time? And those options sometimes were 5% or 3%. The only other major concept that I always like to say, like, what is long-term care insurance and how is it built? There's this concept of an elimination period. It's also called a waiting period. But for those of us that don't know their way around these kind of phrases, think of it like a deductible. And it's a deductible that's measured in time. How much time elapses from the day that you start needing help and cost of care is coming in that needs to be reimbursed? How much time goes by before the policy starts paying their benefits? Those 4 factors, those are the majority of the factors for the overwhelming majority of long-term care insurance that's out on the market. And that's basically the chassis of the policies that I was selling through the 90s and the 2000s. What I'm going to do, and I took the screen down for a second because part of getting us to today is what's happened in the long-term care insurance industry from the 90s when these policies came out all the way to right now. And there was a few big factors. And it ended up with the news that your questionnaires gave you, with a lot of premiums are going up in unexpected ways. Long-term care insurance came out in the early 90s, and it was basically based loosely on ideas around disability income insurance and term life insurance. And the idea that all of the insurance industry was coming up with was, how do we sell these policies and make some profit from the period of time between when premiums come in and way down the road when some benefits go out? And I want to remind everybody, that's how insurance companies make money, right? Premiums come in and they try to figure out how much in claims are going to go out sometime in the future. And then they try to make money on the carry from when the premiums go in and the benefits go out in the future. Over those period of years, I want you to remember the first thing that happened was interest rates went way low. So when they're promising benefits in these long-term care insurance policies to go up by 5%, but they're only earning 3 or 4% on their money, that's one of the reasons that the policies were not able to sustain their business model. The second thing that ended up happening, and I think nobody saw this coming. I didn't see it coming in the early part of my career. None of the insurance companies did. But there is this idea of retention. There was an assumption, and it was a wrong assumption, that people that bought their long-term care insurance in the 90s, when it came out, that there was going to be a percentage of them that were going to stop paying their premiums, that were going to on purpose drop their coverage to look a little bit more like term insurance or to look a little bit more like disability income insurance. Well, what happened, and you know this, the way that I'm leading the story up, nobody dropped their policy. The year-over-year drop rate ended up being less than 5% typically, depending on which book of business. So that gets us to the 2015s, the 2020s, and the insurance industry is looking at, we have a whole lot more people in this book of business that we're supposed to pay claims on than we thought were going to be there, okay? Because nobody dropped their policies and interest rates were a lot lower from that period of time where the money came in premiums before these claims are going out. None of this is making any profits. As a matter of fact, it's a significant loss for a lot of these different insurance companies that they took a lot of write-downs. So what you saw in the last handful of years, let's say 5 years, most of the retail long-term care insurance companies stopped issuing new policies altogether. They came out with new products that were a whole lot more expensive, that sometimes were much more difficult to get underwritten for. And these products usually use some concepts like permanent life insurance, which I can talk about in the Q&A. But what I want to focus on is, what do we do with these policies where the plan, both for the insurance industry and for the policyholders, really didn't end up being what's happening right now? So that's just a little snapshot in history, just to be able to set us up for good questions and answers.
I love it. And I think so often when we're talking about healthcare, it's this, this balance between how much money I'm paying and what I'm getting. And I like how you describe that, because we've got to remember that ultimately, whether we're going to a hospital, an assisted living, or buying a long-term care insurance policy, a company needs to be profitable to keep that alive. Even nonprofits need to be profitable. So that's a great reminder and a great tale of where things are. Okay, let's, before we jump into the pile of questions that we've got here,
I'm ready.
I want to honor this 40% question that kicked off this discussion, and I hope that family is in the audience. But I see Bernie Cohen says, we never got a single 40% increase, but the increase over the years equals at least that. But for that person that might be opening up their envelope, and whether it's 40% or it's an increase, how would you recommend that they evaluate that and the consequences if they decide to say, forget it, I'm not paying?
Yeah, that's a great question. So let me start with just a few slides. Let me advance this to specifically where we're talking about, which is, what do we do about these premium increases? All right, so first off, I think that the most important guidance that I would give would be, take a breath and don't make emotional decisions, because this isn't the deal that you signed up for. I'll acknowledge this is not the deal that you signed up for. It's not the deal the insurance company thought that they were issuing. It certainly isn't the deal that agents in good faith were putting out there. So what do you end up doing? The first thing to consider is, most of the time, not all, but most of the time, policyholders are often given a choice between paying a higher premium or accepting a lower inflation benefit. So there's a lot of letters, Hancock and Genworth and CNA and a bunch of the other carriers have come out with part of these letters that say, listen, your premium's going to go up 20, 30, 40%, or you can decide to lower the inflation benefit, the rate of growth in your benefits from this point forward. And because a lot of times, Steve, that choice ends up being very specific to the personal policyholder, that's part of the reason that you haven't seen fiduciaries like me that are trying to give advice in everybody's best interest. That's why you haven't seen a rule of thumb that everybody should do this when faced with premium increases, because it's going to be specific to the individual. And I'll give you some considerations, because I get these questions all the time, both from my clients and from other folks. The first consideration is what your current age is. If you're taking a look at a premium increase where you've got, the possibility of having to pay 30, 40, 50% more premium, what's your current age? Because the approach that you take for somebody who's in their 60s is going to be very different than somebody who's in their 80s. Because if you think a little bit about what we learned from COVID and how it's impacted the senior housing and healthcare industry, is we have very, very strong conviction that the inflation rate, the rate of increase for these kinds of services, is going to go up very significantly, because that labor pool that's working in senior housing and healthcare is so compromised after COVID. So we're looking at out-of-pocket expenses that are a lot higher than we anticipated. So current age matters, because the younger you are, the more resistant you should be to giving up a higher inflation benefit, which means you might, in your best interest, have to be more open to paying the higher premium and to go through a different analysis. So that's factor one. Factor two, you also have to consider what your current daily benefit is. How much insurance do you really have right now? And a lot of times those letters that come out, it'll tell you. You want to compare what your current benefit is to the cost of care in your area, or the cost of care in different settings that might be most appropriate for you. So for example, if the cost of care in your area ends up being $300 a day, I'm making a number up, and your long-term care insurance policy, because you were very conservative back when you bought it, is a $400 a day benefit, you've got more benefit than the average cost of care. And maybe for that policyholder, it makes sense to forego that hike in inflation and to keep the premium as it is. So that's like an example of like two different factors where you give two different pieces of advice. Another piece of advice is current health. So I'd ask everybody that's considering, what do I do about these long-term care insurance premium increases, to do a sober evaluation of what your health looks like, particularly for families or individuals that are facing any type of chronic illness or disability, or have health factors that make you a higher likelihood of perhaps making a claim in the future. I take a defensive position and I say, is this the right time to be dropping any benefits? Does it make sense to pay that increase in premium just to get the maximum amount of coverage? The other thing to remember with these premium increases, all of the policies that were sold in the early 90s, when I was looking at them, particularly ones that were standardized after 96, they have a waiver of premium clause if you make a claim. So even though we're talking about paying higher premiums right now, 40% in your example, if that policyholder makes a claim, they don't have to pay premiums, period, whether it's the base premium or the 40% higher premium or whatnot. So considerations on your health right now is material in deciding what to do about these premium increases. And then the last point, and this is what we do in terms of some calculations, and I would invite professionals or individuals with long-term care insurance to do this on their own. My last bullet, the affordability of additional premiums. I want you to consider how much more money those premium increases are going to be over the course of a period of time. And I'll give you an example. Let's say the next 10 years. So if I'm a policyholder and I'm paying $5,000 a year for my long-term care insurance, and the premium goes up 40%, let's say it goes up to $7,000, okay? That difference, that $2,000 a year, if I project that forward over the next 10 years, then that's an additional $20,000. And the question that you would have to ask, you don't want to make the analysis just only in today's year, but if I'm paying $20,000 more over the next 10 years, what benefits would I be getting if I take that additional premium and keep the inflation benefit where it is? Or do I keep the premium where it is? I save that extra $2,000 a year and maybe don't have my benefits grow as quickly. What a lot of times, Steve, I do is I look out 10 years into the future and I ask my clients, is it worth paying the extra $20,000 to be able to get an extra $50,000 a year of benefits? That's the difference in terms of the growth on the inflation protection. And all of these numbers are going to be specific to the individual, but I would invite people that are thinking about these premium increases, don't evaluate it just today. Think of it moving forward and think of the benefits that you might forego if you don't take that premium increase. And you're going to find across everybody that's listening, very different answers or very different recommendations about what you should do. But those four factors, age, current daily benefit versus cost of care, current health, and then thinking about it over time, Steve, those are great places to start to come up with a good evaluation of what I should do with these increases.
Man, this is great information, and I'm glad we're recording this for folks to share it and for us to go back and you can listen to what Tom just shared again. So let's dive into some of these questions.
All right, I'm ready.
Okay,
Seatbelt is on.
So Martin says, I have a long-term care policy that has a max out-of-pocket value of $45K and a 3% inflation adjustment per year. The yearly premium is about $350. Would it not make more sense to place $50,000 in a growth fund? That way I have money to use as I like, and should I not need LTC, and also eliminate the risk of significant increase in premiums or charges to the policy? Good question, Martin.
Okay, so Martin, what I would start with, I don't have the benefit of knowing the rest of your financial situation. So take any of this stuff with a grain of salt. This is approaches to the answer as compared to the answer. So good place to start. The first thing that I would want everybody to do, and I do this with all of my planning. I don't do long-term care insurance anymore from a sales standpoint. I do lots of other planning for this kind of expense. I always want planners, clients, seniors to anticipate that spending some amount of money on senior housing and healthcare is a certainty in retirement. If you knew, Martin, that you're going to be having the average amount of help that a man in the United States needs, okay, in your area, which is usually the latest data is a little bit more than 2 years. If you knew that was an expense, I think that puts a different spin on your question. Like, what's the best way to pay for 2 years of help towards the tail end of my life? And then it gives you the prism that you can look through that $50,000 question. Because what you're asking is it okay to sacrifice that $50,000 in assets in that growth fund that you're talking about and not pay the premium on the long-term care insurance? Well, that depends a lot on if that $50,000 in that growth fund has any other jobs for you between now and when you might pass away. Is that part of a legacy for a surviving spouse? Could you need it to supplement standard of living? If there's other stuff, if there's other responsibilities that you would assign the money that you would otherwise budget for long-term care, then I think it puts the potential value of that $350 of premium in sort of a different place. A lot of people that I'm recommending to regularly, I will share with you that most of the time I'm recommending to people keep their long-term care insurance because it still is the most leveraged way to pay for an expense that I think is more likely than not likely. But if you're very wealthy, if you don't have anything else to do with that $50,000, is the idea of foregoing long-term care insurance that you already have purchased. That might be a possibility for you, but I'll leave it with this, Marty. Nobody's shedding crocodile tears for the insurance industry. Even though boo-hoo, we're not making the profits that we thought, we got real people and real seniors sort of try to navigate this. And I want you to think of this. the long-term care insurance industry, through these premium increases, is also making it really, really easy for you to drop your policies. Okay, there's a big checkbox on a lot of these letters that you're getting that says, listen, if you just want to walk away and not pay any premiums anymore, like, we get it, just check here and we'll give you some tiny, tiny, tiny amount of walkaway benefits. I want you to think cynically. If an insurance company really, really, really wants you to do something, is that probably in your best interest? I don't know. I think the idea of maybe you don't want me to keep this policy. Maybe it's better for you and it might not be better for me. So I really think carefully about dropping any coverage that you've got as a rule of thumb. That doesn't mean that dropping it isn't right for you. I would just be very cautious of assigning a lump of money that you have that might have some other responsibilities in your life. And I'd also be cynical about an insurance industry that really appears to be making it easy to off-ramp into dropping your coverage. I'm not making that recommendation regularly.
Man. All right, some great questions here. I can't wait to hear your answer, but I'm going to blend a few together here. We got Joe, we got Eric, and we got Leah. And so Joe is saying, what do you suggest for somebody who's told that they won't pass medical underwriting for long-term care insurance? And Eric is saying he's 75 years old and a cancer survivor and can't afford it. And then Leah is saying, at what age do you suggest people buy long-term care insurance?
Okay, so there's a bunch of questions. All right, so let's break them into smaller pieces. For individuals that are not eligible for long-term care insurance, like they don't even have a choice of whether to buy it or not because their health precludes them, what I would suggest is there's a likelihood that the reason that you can't buy long-term care insurance is that you don't meet underwriting requirements. The underwriting requirements, the insurance industry thinks, gives you a higher probability of needing to spend some of that money on senior housing and healthcare down the road. So the first thing I would do, absent long-term care insurance, I think it's the appropriate response to plan out in advance what kind of help I might need. What are reasonable projections of the plan of care? What a plan of care is what might be prescribed for you with diabetes, with mobility challenges, with mild cognitive impairment down the road, and get a pretty good handle of what kinds of things those cost in your community. And I think that the best way always to deal with the ambiguity of something that's scary is to name it and measure it first. Because then you can actually get to the problem solving of, okay, exactly how am I going to pay for it? Do I need to accelerate withdrawals out of my investments? If so, maybe I get some advice about which investments. Realistically, am I going to need to sell my house? If you realistically need to sell your house, you need to have an understanding of how long into a period of care that you're paying for, if you don't have long-term care insurance, can you go before you have to sell your house? You want to not be in a situation where, because of inattention or failure to plan, you go through a chunk of your money and then you're just left having to sell your house on a fire sale. Plan ahead for T-minus 6 months, T-minus 3 years. I know based on where I might be on a plan of care, equity in a home might be coming up for discussion. Those are the first pieces of advice I would give those that are health disqualified for even considering long-term care insurance. And that reality is reality for more and more consumers. Part of what's happening, Steve, in the long-term care insurance industry is underwriting is getting much tougher. When I was doing long-term care insurance in the early mid-90s, there were no health exams that were expected across the board. Now it's almost standard that if you apply for long-term care insurance, you're going to have a nurse come visit you and poke around in your medical records and height, weight, and blood and the rest of it. Like, that's a new requirement because it's very, very difficult now to be purchasing. So the stories that you're getting that are implicit in some of these questions is happening more and more. I think that the best approach, if your health is precluding you, you need more certainty in terms of what's the available care, do you have access to it, what's it going to cost, and then figure out with a financial advisor, with your family, what's the optimal way to apportion my assets or my income? What choices might I have to make in that circumstance? That's probably the best way to approach that category of questions. There's another question in there. It said, okay, when's the best age to buy long-term care insurance? There's sort of two ways to answer it. From a very high altitude, you can say most people buy long-term care insurance in their 50s or 60s. That doesn't mean it's right for you. It's just when most people buy it. The reason most people buy it in their 50s and 60s is it tends to be before an age where there is a higher likelihood of chronic health issues that might be problems. And it's also before the age where premiums that families have to think of paying out of pocket really start skyrocketing. It doesn't go up in like a straight line. It goes up in like the hyperbole line. Like once people are like early 70s, it just shoots right up. The third question that you embedded in your spray, Steve, was is there sort of a financial net worth, circumstance that you do and you shouldn't have long-term care insurance? Well, I guess again, rules of thumb. The first one is go back to the advice that I gave somebody, the group of people that were health disqualified from thinking about long-term care insurance. If you need long-term care in the future, and again, I come from a school of thought where it's more probable than less probable. Where exactly are you going to pay for it? What's your strategy? What's your plan? Because everybody that doesn't have long-term care insurance, then they have a plan, even if they don't know it. The plan is you're going to be paying out of pocket. And because Medicare doesn't pick this up, Medicaid only picks it up once you spend through your assets. So everybody's plan, absent long-term care insurance, is you're spending out of pocket right now. The advice I would give when you're thinking about how much money do I need to buy this insurance is, why don't you first see how far your own income and your own assets could go towards paying for these projected expenses? I think that there's an answer in there. If it ends up being like, wow, it might be a big chunk of money, and the wealth that I have that might have to go to these expenses, I would really prefer to do other stuff with it, standard of living, legacy, surviving spouse, whatever that ends up being. And if that threshold is met, like, wow, I've got different responsibilities for my wealth, that might move you more towards considering long-term care insurance, presuming you're health qualified. Last point, the financial services industry has a general rule of thumb that long-term care insurance premiums shouldn't be too much higher than 5 to 7% of your income, right? That isn't for everybody, but you got health and bad health, you've got money, you've got premium. That's a good place to start with an audience that is as diverse as who's coming together today, but good questions. And I'm glad you gave them to me all at once. You kept me on my toes.
Yeah, no, I figured that's the best way to get through this big list here. Okay, so Diane says, I have a Genworth policy with a 90-day elimination period. Any advice on the best way to handle this in the most efficient manner?
Diane, sort of two things to think about with your Genworth policy. The first one is, that's going to be part of the plan that you have to cover costs if they come down the road. So there's sort of two components to it. The first one is, what are the realistic costs of housing and healthcare for you? And does your Genworth policy cover all of that on that daily benefit amount? Like, are you short or not? In your area, is it $300 a day and your policy only covers, $200? That shortfall of $100 a day or whatever it ends up being, you need to know, Diane, like where you might be coming up with those dollars from. The second thing that you sort of built into your question, it was, hey, I got a 90-day elimination period. So 90 days is about 3 months-ish worth of paying out of pocket for care. You want to make sure that you know in advance, in your liquid reserves right now, where you're going to come up with that $90,000. And depending on what you've got, home equity lines, cash in the bank, IRAs, the answer, Diane, is going to be different for different people. But those are the two things that you said, like, what's the best way to think about this most efficiently? Figure out that 90 days, how you're going to pay for it on the front end, and then figure out over the long period, is your policy covering the full cost?
Okay. I'm going to jump the line here because I like this question. It's very personal. It's heart-wrenching. Deborah says, my mom, who's 79 years old with Alzheimer's, has a very generous long-term care policy. However, I cannot get her approved in order to begin covering the cost of her care. I've appealed multiple times, but due to COVID, the assessments are done via Zoom, and my mother presents very well. Any suggestions? And I like that question, Deborah, because we're jumping from you're buying this policy to, okay, I've got a policy, and now I'm ready for it to be activated.
Okay, all right. So two things when you're thinking about these claims. All right. Basically, Deborah, you make a claim on your long-term care insurance with two conditions. You either qualify because you have a cognitive impairment, which can be tested using a number of different analyses that geriatric psychiatrists use regularly. Folks in the memory care space use regularly. SPMSQ, Minimax, there's sort of code language that if mom has dementia, you've heard before. Those types of tests are quantitatively based. And if she passes or doesn't pass those tests, that's something that you should be able to work with. The second way that you could qualify for benefits is if mom needs any assistance with any of her daily activities, eating, dressing, toileting, transferring from bed to chair, maintaining continence, or bathing. And the threshold on how much help you need there is something called substantial assistance. And what that generally means is if somebody needs help at least half the time they perform those activities over the course of a week. There's also something in there, if you're thinking about cognitive impairment, called standby assistance, where standby assistance generally is, listen, mom can do all her stuff, but she's frail, she's got balance problems, and maybe around a wet bathroom or something like that, a doctor is going to prescribe somebody just to be around to make sure your activity of daily living mission gets accomplished. That's another way that claims can be made. Digging into your question a little bit, the other thing that is required on these long-term care insurance claims is you've got to be receiving benefits. Okay, so you have to be basically prescribed care that costs money that you're receiving for the claim to go through, right? So that sequence is important. Sometimes people want to press the button on getting the claim going and then pay for care. Like that's not how it works. Remember, that elimination period sometimes is 3 months. You got to be paying for the help with the cognitive impairment or the activities of daily living, go through the elimination period, qualify for benefits, and then get reimbursed on the back end. That's the way it works. The only other thing, thinking about appeals, where do people oftentimes get turned down? They oftentimes get turned down because the insurance company doesn't think that you're qualifying for benefits. That could mean they don't think, when you say she presents very well, maybe they don't have evidence that she has cognitive impairment that's tested, that's diagnosed from a qualified medical professional. That's something that you can probably get a diagnosis to support on your appeal. If you're just appealing, like give her another test, it's not going to be enough. Get somebody that diagnoses. That's going to be a place to get started on your appeal. The other thing that might be a reason for a decline is you're not paying for services yet. They might be waiting for you to pay for services based on that diagnosis. That's another thing that could be holding things up. I'm very sympathetic with the COVID virtual things, and I'm sympathetic with folks that present very well. So I appreciate where you're coming from. Good luck.
Great response, and I hope that was helpful to her. And I want to read Owen's message in the comments where he says, my wife was in a memory care unit with Alzheimer's disease for nearly 3 years. The total payout from long-term care insurance was way over the amount of 20 years of premiums. I would be on a Medicaid candidate now if as a widower without that policy. So Again, I know we have so many challenging stories, but it's great when you hear something like Owen's story, where that policy was truly a lifesaver in preserving assets for a healthy spouse.
Yeah, and
Um,
Steve, let me just respond to that. I mean, I think that for all the reasons about premiums going up, I mean, knocks on long-term care insurance are kind of deserved for people that haven't made a claim yet. Like, this isn't what I signed up for. Why am I paying more premiums? Discuss. But the long-term care insurance industry is standing by its contracts. They're paying out, Diane's question aside, they're paying out in the mid to high 90% of claims that are submitted. It is absolutely pain in the neck to get a claim approved. Like I get that with my own clients. It's pain in the neck. You got to get a service provider to sign off to say what they're charging and that the charges are happening. You need to have a qualified medical professional sign off that there's a diagnosis. There's a paperwork about, are you assigning beneficiary to the policyholder or to the provider? Like, it's a nuisance and it's a bureaucracy and it stinks, but it really does pay. That's the thing that I'm sticky with clients of mine or acquaintances that want to think about dropping their policy. That story with Owen, that's consistent with what I see navigating families through this. The average claims on the ones that I see, and this is just one guy and one anecdote, but I'm not getting too many claims that are not in six figures over time. I mean, these are big numbers that they're paying out, which is why I'm reticent to come up with any advice that sounds like drop your policy. That's not my baseline. My baseline is figure out a way to keep it if you can.
Okay, great. And okay, so just advance warning to everybody. We got a pile of questions, and we're going to get through these. Tom, are you cool hanging on for longer today? Okay, good.
Yep.
Okay, so this is one where I'm going to drop a discussion we recently had into chat. But how does the long-term care insurance work with the new continuing care at home programs? There's somebody from Spring Point who made a comment. We've got Goodwin House at Home. There's a brand new Maryland continuing care at home. And I know you're familiar with these platforms, so maybe you can share some information on, because I believe there's an insurance vehicle tied into a lot of those.
Right. So we got to start when I'm asking that question for a broader audience. What is a continuing care at home contract, right? So continuing care retirement communities, okay, they're also called life plan communities, right? These are communities that are regulated by state insurance commissioners because they offer some guarantees on the cost of care or the availability of care for a population of seniors that effectively move into the four walls of these communities. And how the business of these continuing care retirement communities effectively works is they make sure that residents know in advance what kind of help they have access to, and some of them by contract will spell out in advance what those costs might be. And a lot of these contracts basically say, in the event that you run out of money after you move in, we'll make sure that you don't have to be discharged back into the community. We'll take care of you, right? That's what a continuing care community is. The next level is, what's a continuing care at home? Well, continuing care at home, Steve, you said it right. What this is basically, it's a contract with one of these providers, all right? And the providers, at least in the state of Virginia, where I'm from, they require any at-home providers to include this new benefit to people that want to live in their own home. They require them to also have a pool of seniors in a retirement community to make sure that the risk isn't just transferred just to the people at home. How continuing care at home contracts work with long-term care insurance, they're a little bit like a Venn diagram, okay? And long-term care insurance, remember, gives cash flows to families to pay for expenses after they're incurred, generally speaking. But they don't do anything about early preventative help for folks. They don't do anything about guaranteeing access to different types of service providers. They don't do things like actively do home assessments to make sure that people are safe and living alone. Those are the kinds of things that these continuing care at home things do. But the continuing care at home pieces, what they generally are doing is they've got a hybrid of 3 different offers baked in. One of them can sound and feel a little bit like long-term care insurance. So for example, people buy in for a dollar value of care that's bundled in that contract. And that looks a lot like long-term care insurance, right? But people can have more of that insurance concept or less of that insurance concept. One thing that a lot of these continuing care at home contracts have discovered is there are plenty of affluent people that don't want long-term care insurance or already have long-term care insurance, and they don't buy a lot of embedded insurance inside of the continuing care offer. They're interested in the other 2 pieces. And the other 2 pieces is it's the continuing care at home group's responsibility to staff the help that's coming in. It's their responsibility to make that available. And generally speaking, the third piece is that continuing care at home, they take, because they know this works from their community, their residential work, they take proactive steps to keep people as healthy, as independent in a home setting for as long as possible. That's not something private long-term care insurance does. So they work together, but you got to be on purpose if you're doing both of them. You want to be mindful of, if you're buying the continuing care at home piece, not to be over redundant on this coverage concept if you have long-term care insurance. But I'm very excited that these offers for continuing care at home are coming to the market. My belief is in the years ahead, it's not only going to be the affordability of long-term care services that people have to plan for. I believe sincerely after COVID, we have to plan for access. We have to plan in advance to know where we're going to go and who's going to be around for me, because I still think the labor market in senior housing and healthcare is going to continue to be constrained. And for people that want to receive help in their own home, I think that you want to plan ahead for where might that help be coming from, and can I guarantee that in some way? That's separate and discrete from how am I going to pay for it. You're on mute, Steve.
We could have a great discussion on that one. Okay, let's see. Somebody says, our proposed rate increase last year was over 45%, was reviewed by the Virginia State Corporation and found to be compliant with the applicable VA laws and regulations. I can only imagine what it's like if we walked into a grocery store and something was 45% more expensive. Any thoughts on how you sleep at night with that, Tom?
Well, I think that if I'm wearing my consumer advocate hat, how come the insurance commissioners are approving all these increases, says a consumer advocate? And I think that the answer really comes down to, in the contracts that they wrote, even the ones that I sold a long time ago, they had a clause in there that says, we have a conditional right to increase premiums on in-force policies. So that's in the contract to begin with. And what it basically said is, we can't pick on you individually, but we can for a class or a particular part of a book of business that might meet some metrics that they've got to show the insurance commissioners. They can raise premiums for a book. So part of the frustration with insurance commissioners and how come they're improving all this stuff, sort of 2 things. I have clients asking me all the time, what do the insurance commissioners say? Like, I don't know. Nobody knows. It's a black box. I can say that when these premium increases started, we know that a large group of insurance carriers all approached most or all of the insurance commissioners at the same time. So the precedent was set. This industry has a failed business model, and it was sort of setting the stage for how do we keep the companies from going under on this particular book of business. And the insurance commissioners, they need to have these policies viable enough to be able to pay their claims. So it ends up just being, a frustrating friction, I'm sure, behind the scenes, but there isn't any public information out there about how these things are actually getting approved. They either get the thumbs up or the thumbs down. Unfortunately, it's in a black box. It's a conversation I've had a lot. The most we can do is work through the options that we have on hand and make sure that they're relevant to us.
Great. Okay. These, I think, are related here. Elva says, please discuss hybrid life insurance, LTC policies. And then somebody says, I'm in my last year of a long-term care insurance policy with 10 years of premiums. So 1 year to go to finish the policy payments. There are all these new hybrid products now. Are any of them advantageous? My gut level feeling is, doesn't that person, if there's a term, aren't the hybrid programs the ones where you can kind of like pay in and then you stop? Does this person potentially have one of these hybrid programs? Tell us a little bit about these hybrid.
Well, let's pull some slides back up, and what I'm going to do is I'm going to talk a little bit about what are the different kinds of long-term care insurance, and what the different kinds of long-term care insurance are. There's basically 4 of them. Okay, the one that we've been talking about is this one, which is standalone retail long-term care insurance, dominated by mutual insurance carriers. Sometimes some of them have benefits that a couple can join together. I didn't know if we were going to get any questions on that. That's why that's there. They've got, these policies are the ones that have some partnership with the state. If we want to go into more detail about that, I can, but generally speaking, that ends up not being material for most folks. It's the next slide where we're talking about the hybrid ones that I want to address. And then I'll get back to the guy with a year left on his 10 pay. The hybrid policies are basically, one of them is built on a life insurance policy. So typically these are universal or whole life policies that, on my second bullet, it looks like this. At the time of your long-term care claim, you might be able to get your death benefit prepaid to you, okay? So think the insurance company already knows that they're gonna be paying the death benefit out. So they're just giving you that benefit that's coming anyway a little bit early. And then if you fully exhaust the death benefit, there might be some extended only long-term care insurance on the back end. These policies are expensive. These policies are also much more likely to be cost prohibitive once you get into your late 60s and 70s. When I say expensive, I mean $100,000 of premium down. Like these are expensive. So, but the consumers sometimes like this. Like if I put 100 grand down or whatever the number is, it's a big 6-figure figure for the ones that I see. At least I know when I die, I'll get that back. And if I need more help, I can just get it prepaid. And if I need more help, exhaust the long-term care, the death benefit, I might be able to get more. We'll talk about this in a second, back to your question, but there are some differences. There's also life insurance here that has chronic illness riders. These are not the same as hybrid policies, okay? These are basically ones that don't have, on my last bullet, they don't have standardization in terms of how you might get your death benefit prepaid to you. So a life insurance policy that has a chronic illness rider, that can mean different things. That is not the same as a hybrid policy that you can fully exhaust the death benefit and then get long-term care benefits on the back end. These policies basically are like life insurance with maybe some fine print that maybe you could get some of your money earlier. They're different. The last one is there are annuities out there that are considered long-term care insurance. And the only reason people are going to be doing this, they're really not selling these right now, but the only reason that people can do this is if you have an annuity that is not in a retirement plan, that you have some appreciation in it. A lot of families have these annuities and they basically say, look, what do I do with this thing? Because anytime I take money out of an annuity, it's LIFO, last in, first out. I got to pay taxes on the interest first. Sometimes those annuities you can put into a long-term care annuity, and that money that comes out, you don't have to pay any taxes on it. That doesn't leverage up like long-term care insurance or hybrid insurance does, but at least maybe it gets out of some 1099s coming in. Those are the 4 different approaches to long-term care insurance. So zeroing back to the hybrid question and then your 10 pay. I think right now, the only stuff that's selling by and large in the country are these hybrid policies, which are super expensive and hard to be underwritten for. The retail long-term care insurance, the standard ones that I sold back in the day that were spending a lot of time on these questions about premium increases, they only sold, the whole industry only sold 50,000 last year across the country. So the insurance industry doesn't want to write these. They're being phased out. There are only a handful of carriers left. The reality, soberly, is the policies, the insurance that we all want, that has a lot of benefits, that's affordable for most people, that doesn't exist right now. That just is the state of affairs with where we are in the insurance cycle. And knowing that that is a reality should incentivize all of us to get planning now. Because if you have the long-term care insurance, you probably want to keep it and figure out what you're doing with these increases in premiums, or absent long-term care insurance, because it's not affordable or because of crummy health, I got to make some other plans on if my care is diagnosed down the road, how exactly am I going to pay for it? You don't want to make that decision in an emergency room. You want to make that decision in advance and communicate it with the other decision makers in your family.
Great. Okay.
10 pay, I forgot to, the guy's got 1 more year, good for you, pay that year, and you might be done. You might be the guy on this call that has the best possible scenario, because if you don't owe any more premiums, then they're not going to raise the premiums you owe in the future. Those kinds of policies, depending on how much they cover relative to the cost of care in your area, that might be the best scenario out of the bunch. So I applaud you for taking that step 9 years ago. Absolutely pay that extra year. Keep your eyes open, but I wouldn't knee-jerk into those hybrid policies. I would keep what you got.
Okay, great. And then, okay, we got another question. This is just reiterating filing a claim. And this individual says husband has an LTC policy. He has dementia, but he's living well at home, been paying premiums for 15 years. And you had answered earlier that you've got to be accessing services. So would one approach maybe be with this family to, like hire a home care aide or something like that, just to get the ball going, and you're accessing to enable to trigger that accessing services. Is that a good strategy?
Oh, I mean, I'm glad you mentioned that, because I mean, this really goes to my heartstrings and places that I'm real passionate about in this dementia community. That's something that got me going on a career path. So it's a heartfelt answer. There's 2 ways to answer the question. I don't want to answer it first on the money side. Let me answer it on the dementia side. One thing that we know about dementia is early interventions in terms of any kinds of therapy, in terms of any type of different kinds of programming, makes an enormous difference about the impact of the onset of symptoms as you go. So the first thing that I would say to anybody that's dealing with dementia, look in your community for places that you can get support early in a diagnosis. And just because somebody is living well at home now, that's the time to start plugging in any type of therapeutic programming or support that can keep people at a higher level of acuity for longer. So I'm saying that from a health standpoint. Raise your hand for help earlier as compared to procrastinate and wait for a decline to accelerate, because at that point, you might have lost a period of time of higher function. So I'm saying that on the health and the family side first. To the way that, Steve, you asked the question, absolutely. Should you be looking at getting some services, not all services, but some services, just to get the ball rolling on the long-term care insurance? I make those kind of recommendations every day. I start with early interventions with dementia make a huge difference in terms of onset of symptoms. And then I go back to the policy. Look, you don't have to use all of your benefits You can just use some of your benefits. It's not typically a use it or lose it in the pool. So if you're just using like Insight Memory Care Center is an adult day center that I've had the privilege of working with for way more than a decade. We're always trying to tell people, just come in for a day, just come in for a support group. Can you use long-term care insurance to pay for some of those supports early, even if they're sporadic and lightweight? The answer is overwhelmingly yes. Check with your policy, but I really like the way that you set that question up.
Great. Let's see. If I look at
By the way, there's a question in here. I
yeah.
also want to talk about, there's Joan Rubitz Kritz, cognitive impairment diagnoses alone will not usually qualify to activate a policy. That is not correct. Joan, sorry. Most policies have separate triggers that you can do one or the other, okay? This was part of the language that was standardized in the mid 90s because I sort of lived through it. When policies that did that they said like cognitive impairment, but plus long-term plus activities of daily living, your memory is right. That did exist. That was on like old Hancock policies that I sold, but all of the contracts updated to new language that had separate triggers. So you could do cognitive impairment exclusive of activities of daily living. Check your contract, but I don't want you to hesitate at least pursuing that. I'm scrolling through the questions too, Joan. I wanted to get that point to you.
Great. Okay. Let's see. Joan also says continuing care at home programs are not all the same.
That is a true statement.
The one good thing about those programs is they seem to be sort of geographic. There's usually not a bunch of different choices in one geographic region. There's usually one provider there, which may or may not be something that you like if you're looking into that. Can you comment on the long-term care insurance policies available to federal employees?
Sure. There's a lot of long-term care insurance policies that are out to feds that are outstanding. They were underwritten by Hancock and then Hancock and MetLife in a partnership. And they were not excluded from these premium increases. So early when these premium increases started coming around, policyholders that were part of this federal program, I think were appropriately out of joint, like, hey, we're feds. How come we're getting treated like private pay people? And it's because it's by a private company. The federal government's not subsidizing this for everybody. They just made a private benefit available for their policyholders. The coverages, generally speaking, are every bit as good as what's available on the private side. The federal policies are also expense reimbursement models. They follow those things with daily benefit and the two triggers with cognitive impairment and activities of daily living. They've got a choice with inflation benefits. They also, with those premium increases, also typically gave you a choice to keep your premium where it is at the expense of higher inflation coverage. So there's a lot of policies out there that fit into the category of the conversation that we talked about earlier with what do I do with my premium increases.
Okay, so it sounds like there might be a little bit of an asterisk there. If you're a federal employee, it might be a little bit, the situation might be a little bit better to investigate long-term care insurance.
Mm-hmm.
Okay. Question. Tom mentioned two ways to look at when you're purchasing long-term care insurance. The first was for those over the age of 50. I don't recall him discussing the second way to look at this. If it was not addressed, could he discuss the second way to view this?
Sure. Two ways to look at it. Certainly your age, okay? And then the second one, I think I said it. The second one is, there's a rule of thumb that most folks are recommending don't pay more than 5 to 7% of your annual income in long-term care insurance premiums. Also, the thin slice of making sure that you're healthy enough to qualify for benefits, that goes sort of without saying.
Great. Okay.
But I've been known to say 3 things and only saying 2, so now I'm ready for that critique.
Okay, and then let's see, I got a question that's going to tee up the long-term care affordability product that you've got. I want you to talk about that for a bit, but first it says, can you tell me how you think about the fact that the pay-in to many policies are lost if not used. Can you talk about how you think the fact that the pay-in to many policies is lost if not used?
Yeah. So respectfully to the questioner, that's how most insurance works. Okay. Most insurance is something called, real or absolute protection, which is the only way you get a benefit out of it is if you would otherwise have a big expense that gets reimbursed. There's no winning in long-term care insurance. You either pay the premium and don't make a claim and you're out of the premium, or you pay the premium, you make a claim, and the policy pays a lot of benefits, but you still make a claim. Long-term care insurance is all about risk mitigation. There was never a factor in the original policies that were building in any guarantees of premium return. If you want to think of it this way, if you're thinking of an insurance policy where somebody gets something when you're dead, that's life insurance. And that sometimes is in part of these hybrid policies, but that's not how long-term care insurance is built. It's also not how health insurance is built. It's not how your auto insurance is built. It's not how your homeowner's insurance is built. Like most insurance is, if you never make a claim, you're out the premium because it's based on a pure risk reduction model. It's only life insurance that guarantees you something back in this world that we're talking about if you never make a claim. And I always like to say, don't buy life insurance unless somebody needs money if you're dead. Like that's a good place to start, which is part of the reason that that question is really well received from a consumer guidance standpoint.
Okay, so I'm going to make this the last question. I did just glance at chat and I see there's a ton of chatter in there and a lot of great questions. I see there's people in the audience that are answering questions, which is great. But I want to ask this question, which I think will tee up one of the major projects that you're involved with. Fran says, if I look at the present value of my stream of payments and then what I might obtain in benefits, I can decide if it's right for me or not. But the problem is I have is assessing my costs. How many times in the next 30 years will my insurance company give me a 20 to 30% increase? I've had 2 increases in the last 7 years. But Franz, I'd also like to throw on the pile of that question is not only the cost of your premiums, but what you're buying this insurance to pay for, the cost of that, and how do you calculate that and know that you've bought this policy that is paying for something and what that cost of the policy is. And I hope this tees you up to tell a little bit about what the long-term care affordability
Sure.
is.
And I'll sort of close on this. I'll start with a story and then end with a response to the question. So early in my career, the market didn't know what long-term care insurance was. So I was meeting a lot of families that were really interested in buying long-term care insurance because my wife just got a diagnosis of dementia. So early in my career, I got sensitized to the number of people that weren't able to sort of health qualify for this funding stream. So I did sort of a scan of what the financial services industry offers to people in lieu of long-term care insurance. And the answer wasn't much. So what I've developed with Lifecare affordability planning, it's a trademark standalone financial plan that people pay a single fee for that tries to answer these questions. And what it tries to do is it builds different scenarios, sometimes for people that are planning ahead. Do I try to stay at home? Do I move into a continuing care retirement community? Do I move in with my kids? What are all the different factors? But other times it's going to be after a diagnosis, which is, could I stay with my spouse at home? Do we have to move somewhere together? How do we pay for all these things? That Lifecare affordability plan is an offer that I'm really proud to bring to the market. That experience, Steve, helps me answer the question. Because I think you've got, Franz, I think that was your name. You've got sort of 2 moving parts. You identified one. What am I going to do if these premiums keep going up? How much are they going to go up? Like, I don't know. I don't think the insurance company knows. Like, tell me what interest rates are going to be doing or inflation is going to be doing. I think that the best way The sober way to answer the question is we can only make decisions on the options that are available to us in any given moment. And every time a premium increase comes back, I think you got to go through the same method. What's my current age? What's my current health? Projecting forward a period of time, is it worth the extra premium to keep that inflation benefit or not? You know, and what's happening with the rest of my financial life where I might have to be exposed to more long-term care expenses. All that stuff gets put together. I think that the biggest challenge, Francis, it's not the long-term care insurance premiums going up, because respectfully, your long-term care insurance premium is probably only, 1 month worth the cost of care at most, maybe a few weeks. And I think it's even more unpredictable what's going to be happening with the cost of care. Like, don't forget what COVID has done to the senior housing and healthcare industry. You've got some projections of 50% of nursing homes are going to go bankrupt because the cross-subsidization between Medicare and Medicaid failed when no one was going to nursing homes for rehab. So you have this whole business model collapse. You have an enormous amount of workers in the senior housing and healthcare industry that didn't sign up for hazardous pay, that didn't sign up for extra liability. This wasn't the work that I thought of. We are in what, 95% plus employment for the country. You have people moving out of these jobs regularly. So who's going to be around to take care of us 5, 10, 20 years down the road? I don't see in the United States immigration policy all of a sudden opening up to bring in a huge number of workers right around the corner. So this is code, Franz, for, I think that the costs of long-term care are going to go up faster than expected. I think that a lot of the national dialogue about how we're going to be financing retirement is pregnant with the unspoken, how are we going to pay for all this stuff that Medicare doesn't pick up? So when you're doing your calculation on the long-term care insurance premiums, please be sensitive that we're in a new world in terms of projecting what the actual out-of-pocket costs for receiving the assistance that we need. I don't think that's being reported on enough. And hopefully that's something that comes off as an understandable response and is certainly a lot of the foundation for the effort that I'm making with Lifecare Affordability Plan.
I love it. Man, we really overstayed our, well, I shouldn't say, I mean, we lost a few people at 1 o'clock, as we always do when we go over an hour, but this was an amazing discussion. I know I talked about having an after party with some of our positive aging champions in financial services, but we've already overstayed our welcome here, so we'll do that at another point in time. But Tom, thanks so much, but really thank you to the audience today,
Yeah,
because
great questions.
these were absolutely amazing, and I love seeing how you're helping each other out in the chat. Again, this is going to be recorded. I'll post it up. I'll send out a reminder with the link. I'll have all the chat. I'll have all the questions. I'll make sure that I put links to Tom and his team's contact info and the Lifecare Affordability website. And we'll look forward to seeing y'all at the next discussion. So thanks a lot, Tom.
Great to see you, Steve. Bye, everybody. Thank you for your questions.